All right, everyone, we will go ahead and get this party started. I want to thank everyone today for joining us for our first educational webinar of 2019. We are wishing everyone a prosperous new year, and hopefully the information we can bring you today can help you achieve and exceed those goals for 2019 with regards to your investing, because we do like to bring you new and interesting topics. One thing that I've made a push for this year is bring you more of the multifamily space, because we've been so focused on the single family home space with our educational stuff in the past that we would really like to bring you some more stuff. And who better to do it than nationally renowned real estate investor Rod Khleif. So we do very much appreciate having him on today for this presentation. Before we get started, we just need to give our required disclaimer that Advanta and our employees, we do not provide legal, tax, or investment advice, nor do we endorse or promote any products. All information is provided for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of financial arrangement. Before we jump into the actual meat and potatoes of things, I want to just let people know the different types of accounts that you can use for these types of investments. It's not just going to simply be the venerable traditional IRA or the Roth IRA. When it comes to being creative in these different types of deals, understand that if you have retirement savings or if you have different types of accounts, you can use these in conjunction, singularly, or across many different planes in order to kind of get involved where you otherwise might not have thought you were able to. So I've enumerated the different kinds of accounts that we typically see done with this. It ranges everything from the traditional IRA all the way over to health savings accounts. The ability to actually have a health savings account invested in a multifamily deal is an actual possibility. So we like to make sure that we bring out the space for not only the type of investing, but the different types of accounts that can also be used for this as well. A small update to 2019. We didn't have a whole lot change after the new year with regards to your retirement account contribution limits, although there was a little bit of a bump for everyone, so that is good. Now, individuals with traditional and Roth IRAs can contribute an additional $500 across the board for individuals under and over 50 and a half. So the new contribution limits are up there. Nothing really changed with regards to 401ks or any other type of retirement account. So just be aware that you do have a little bit of extra money that you can add in there on an annual basis. Whether or not that's deductible is going to be completely up to you, and we can certainly help you make that determination as well. So that's it for the boring stuff. I know y'all are here to hear Rod speak. So a little bit of background on Rod. Rod is a nationally known speaker and investor. He's personally owned and managed over 2,000 homes and apartments. He has one of the top-ranked iTunes real estate podcasts, which has been downloaded as of the last count that I have over 4.5 million times. And I believe, Rod, that you're getting closer to that 5 million mark as well. So congratulations on that. He's also the author of How to Create Lifetime Cash Flow Through Multifamily Properties, which is a great reference point for people that are looking to invest, either getting started or learning the basics, or even seasoned investors of multifamily real estate. So without further ado, I'm going to go ahead and advance this into Rod's portion of it. And again, Rod, thank you very much for being with us here today and helping bring this great information to people to help them reach their financial goals with regards to the new year.
Oh, thanks, Alex. Now let's have some fun. I appreciate those of you that are here, and I'm honored to try to add some value to you guys today. So my presentation is really geared around a high-level overview of multifamily investing. And, it's my belief that if you're going to invest in anything, you need to know what it is. I don't care if it's the stock market, if you're investing in IPOs or in other businesses, startups, and certainly in real estate. Don't dabble. Learn the business so that you're not relying on someone else to manage your money. That's when people get burned and get hurt. So, I'm going to dig right in here. And do we have a Q&A, Alex, at the end?
Yeah, there will be questions that people can type them into the question box, and then time permitting at the end, I will go through those, and we can get some good questions and answers at the end.
All right, sounds good. So how do you make money in multifamily real estate? So certainly cash flow, of course. That's a critical component, and I'll really quickly tell you a little bit of my story. In 2008 or in 2006. I owned 800 houses and multiple apartment complexes here in Florida. Well, because my net worth went up $17 million that year, just while I slept. But there's a punchline. In 2008, it all collapsed, and it collapsed because I wasn't focused on cash flow. which is the reason I started my podcast, the reason I wrote my book, is just to let people know that if you're buying real estate of any kind, focus on cash flow. Value's out the window. So cash flow is very, very important. Of course, you get depreciation, you get incredible tax benefits. There's really nothing else that provides the kind of tax benefits that real estate does. Of course, you get appreciation if the market is going up. Right now, we're near a top, so you have to be very careful because there will likely be a contraction at some point in the near future. You get principal reduction depending upon how long you own the property. You can get acquisition fees if you're putting a deal together and syndicating it, or if you're bringing in partners or investors. You can charge a fee to do the acquisition. You can charge asset management fees to manage the asset, even manage the third-party property management companies. Or you can manage yourself and get property management fees. So lots of ways to make money, even more than are noted here. If you really get into this in a big way and you're syndicating deals, you can charge a disposition fee when you sell the property. You can charge a refinance fee when you refinance the property. So there's just lots of ways to make money in this business if you're doing it as a business. But if you're just going to invest in someone else's, it's still important for you to know this. Okay. All right, I hit the right button and it didn't go to the next slide, Alex.
Try it now.
Okay, all right.
Still not working?
No.
Just let me know when you want to advance the slide, and I'll do it from my end. That's weird.
All right. So if you're going to get into this business and really do this business, investing for yourself, the first thing you need to do is you can't be all things to all people. If you approach a broker or an investor and say, I'm just looking for good deals, they're not going to take you seriously. So you need to create some investment criteria, i.e., I'm looking for value add opportunities in Sarasota, Florida, B class, C class properties that I can reposition and add value to. That's an example of investment criteria. Sorry about that. So you're sorry about the analogy, but it's the only one I can think of. So you're shooting with a rifle instead of a shotgun. Okay, that's how you're successful in this business. You have to know exactly what you're going after. So because there are millions of multifamily properties in this country, and so one of the first things you do is you kind of self-evaluate and you look at I was able to move at that time. You look at your real estate experience. You look at your skill sets. Maybe you've been involved in finance or banking or contracting or anything that parallels with real estate. Take a look at that. Take a look at your current finances, your employment status. Do you have some time you could dedicate to this business if you plan to do this business? But at the very least, if you plan to invest in this asset class, then you need to understand it. And I have a free book that we'll tell you about at the end that'll help you a lot. And certainly I do live events as well. I think we're going to mention that at the end as well. But the point is, I don't care if it's with me. If you're going to invest in real estate or frankly anything, learn it. Okay, don't dabble. Dabblers get crushed. So you're looking at how many hours you can devote to this a week. And I tell people, and I've interviewed on my podcast people that have thousands of units that started on the side with full-time jobs, with children, and now have multi-million-dollar portfolios with thousands of units. So and you can do this with 8 to 10 hours a week if you're interested in doing this business as a business. Hey, Alex, we're getting a lot of background noise. I don't know if that's on your end or where that's from.
Not sure. I can certainly. Let me try this.
Okay. All right. Yeah, that took it. That took it away. All right. Awesome. Okay. All right. Now I wasn't able to advance the slide though. Okay. Now there it is again. Okay. All right. Thank you. So, the next question you want to ask yourself is, what are you going to go after? What type of real estate are you going to, what type of multifamily property you're going to go after, and then what size. So there's residential multifamily, which is 2 to 4 units, duplex, triplex, fourplex, and then anything 5 units or higher is commercial. Let me take a minute and talk about the advantages of each. With residential, the advantages are you can get incredible financing, especially if you're willing to live in the property. You can get 30-year fixed financing. You can get very good interest rates, very low down financing, as high as 97%. So if you're going to live in it, and even if you don't live in it, you can still get 30-year fixed financing. So those are the advantages, and it's a great way to start. If you're thinking about getting started in this business, and you're willing to move into a plex, chances are you can live there for free or very inexpensively, certainly within a year or two as rents progress. So great place to start. But if not, there's still great investments. I've interviewed, people on my show with, a couple hundred units that are all plexes that they've built over a 10-year period. They have multi-million-dollar portfolio. So, you can certainly do it that way. Now, the disadvantage is the properties are valued, residential multifamily, 2 to 4 units, is valued based on the comparable sales. So it's difficult to ramp the value as easily as you can in the commercial space, okay? And so that's why I prefer commercial multifamily, which is 5 units plus. And the reason being is commercial multifamily is valued based on a multiple of the net income on the property. It's called net operating income, NOI. Is the nomenclature in the business, NOI, net income. And the net operating income is the gross income on the property from all sources, less the property specific expenses. Does not include the debt, okay? And you probably all heard the term cap rate, and that's the multiple that you utilize to determine the value. But what's amazing about commercial multifamily is when you raise the net income, it exponentially raises the value. And I'll give you an example of that in a little bit. But you've got to decide, what type and size you're going to go after. So you're going to go after B properties, C properties, D properties. A properties are the brand new stuff, with all the amenities. B properties are the properties that, have been around for a few years. C, it's kind of obvious what that would be, built maybe 30 years ago. Still very, very nice properties. For us, it's built in the 80s. In fact, we just put a C property under contract yesterday in Dallas, a 200 unit property. So, and we're gonna reposition it, make it a B property. So you've got to decide what size you're going to go after. Okay, what are you going to target? Okay, you can advance the slide, Alex. Okay, so the next thing you do, and what's amazing about this business, is that it's a team sport. And let me tell you what I mean by that is if you're going to buy commercial multifamily, they don't look at the individual, they look at the team. So for example, if you don't have all the net worth that you need to get the financing, or you don't have enough liquidity to get the financing, or you don't have the experience, you can put a team together that satisfies those requirements. So for example, if you're going to go out and get what's called non-recourse debt on a commercial property, non-recourse meaning, if they foreclose on the property, they only take the property. They don't come after you personally. That's non-recourse debt. And if you're going to get, and it's typically Fannie Mae or Freddie Mac, and if you're going to get one of those loans, they're going to look at 3 things. They're going to look at your experience. They're going to look at your net worth, and that net worth needs to be equal to the loan amount. And they're going to look at your post-closing liquidity. How much money do you have after the closing? Okay, and that typically needs to be about 10% of the loan amount. Now, what's amazing about this commercial multifamily space is you can satisfy all those things with someone on your team. So if you align with someone in what we could call a sponsorship capacity, you can go out there and buy a multifamily property, even if you don't have credit and you don't have the money and you don't have the liquidity. You give up pieces of the deal, and you're able to put these commercial deals together. And this is how most syndicators start. Okay. Me, when I was in my 20s, I bought tens of millions of dollars worth of property with other people's money, 50-50. They put up the money, I found them, I fixed them, I managed them, and we split them 50-50, and everybody was happy. So that's what's great about this business is you're able to pull people together and do these things in this multifamily space, especially in the commercial multifamily space. So, all right, you can. Oh, now let's keep talking about other team members. So let's say you pick a market area, and you need to pick a market area. It's you're going to want to develop relationships with brokers there. And so I would suggest you go, for example, to loopnet.com, which is the largest commercial multifamily website, and go on there and find out who the hitters are in your sub-market. Who are the, there's always a few brokers that are the hitters. They've got the most listings, and you just reach out to them and start a relationship. And that's the thing you need to remember. If you're going to do this business as a business, if you're deciding, hey, you're thinking maybe I want to do multifamily and actually start buying some apartments, you're going to do this for the rest of your life. This is not a get rich quick thing. This is a become very wealthy over time thing, but you're going to build relationships based on that mindset. So you're going to look for people you enjoy working with, and brokers can make you very wealthy. So you want to develop relationships with brokers. You want to be very responsive. You want to make sure that, if they send you a listing that, you follow up with them, and you keep them warm, for lack of a better way to describe it. You keep the relationship warm, and you're looking for deep relationships, not surface. You're not looking for quantity. You're looking for quality. And so brokers you want to connect with. You're going to want to connect with property managers. Property managers really know the market area and can tell you what the rents are. They can tell you where the paths of progress are. And let me just say this, especially if you're not buying in your backyard. So, you can determine, where you can find out from a property manager where the paths of progress are, where you don't want to go collect rent at night, and things of that nature. So property, and by the way, they can make you a lot of money. I've got a high level mastermind. We've got about $3 billion in assets represented in it with the 50 people that are in it. And one of the guys, a guy named Glenn Gonzalez, actually, and I'm interviewing him tomorrow for my 300th episode of my podcast, which is going out Monday, but him and a couple of other people. But Glenn has 4,500 units. He started out as a maintenance man, but about half those units he got from his property management company. Because the thing you want to think about is if you're a property manager and you're managing a property, who do you want to buy that property if you know the owner is going to sell? Someone you know. And so Glenn had relationships and bought a bunch of properties from property managers. It's very, very common. So again, that's another person you want on your team. And of course, you're going to want to find a good insurance broker, good real estate attorney, and you're putting a team together. All right, you can advance. Alex. Okay, so let's talk about where you can buy. And that's the beautiful thing about commercial real estate is you don't have to buy in your backyard. Now that I'm going to suggest 4 markets, and of course your backyard would be the most obvious. If you have opportunities in your backyard, you want to start there because you know it. Now I consider your backyard anywhere within 2-hour drive in any direction, okay? Because you can manage it. You can go there in the morning and spend the day and come back in the evening and still be with your family. And so I consider that your backyard. Now, these are 4 markets you want to consider. Now, the beautiful thing about commercial real estate is there's so much information online. I mean, when I started in real estate, listings were in a book that you got. I mean, you can go online and find every property that's for sale. You can go on spotcrime.com and see what the crime is on a particular property. In fact, it's very interesting to go on there and put your home address in. You'll be shocked how much crime goes on in your backyard. But then you can start poking around there and you can see where the hood is in any market. You can see where you don't want to buy. And by the way, back to my conversation about the class of properties that you buy, I forgot to mention D properties. D properties are the hood. Trust me, don't do those properties. Yes, they have higher cash flow, but you don't want that kind of brain damage. And I wouldn't invest in them either if you're investing in someone else's deal. I mean, and ask me how I know. Okay, I've owned properties in D markets, and I will tell you, I've had people killed in them, behind them, around them. I've had, a property where they cut a hole in the door to pass the crack through, and properties on streets where they blocked off one end of the street to slow down the drug traffic. Okay, you do not want that brain damage. So it's, take it or leave it, but I would not mess with D properties. But anyway, back to the 4 markets. So what's great about this business is so much of this is online. I mean, you can go on Google Earth and go down to the street view, and you can see what type of cars are in the parking lot of a property you're interested in. You can drive down the street, go to the main intersection, and see what kind of businesses around there. And if there's a pawn shop and a liquor store and a strip club or something, that's a clue. And so it's so incredible that you can do all this from your laptop. We never had the ability to do this before. So, like, for example, this deal that we just put under contract in Dallas, I'm flying out there tomorrow. I haven't seen it yet. A $17 million deal, and we've got it under contract. Our money's hard. We have to close. But I haven't even seen it yet because I've done so much due diligence ahead of being there. Now, I had some boots on the ground there to look at it, but now I'm flying out tomorrow to go look at it. So my point is, you can do all this remotely. So if you live in an LA or a Manhattan or a market that's so hot, you're not going to buy there, that's okay, is my point. Now, so here's the 4 markets I would suggest you consider first. First would be your backyard. Second would be a place you know well. Maybe you grew up there. Maybe you went to school there, but you're familiar with it. The area. Third would be a place you have family or friends, people that live there that can tell you, where you wouldn't want to invest, or can go look at something if you need it, or help you if you need it. And the fourth would be maybe somewhere you'd enjoy visiting or want to retire. Now, those would be the 4 markets I would say consider first. And if none of those apply, then just go find something that's not too far away. I live in Florida. I would not invest in Nevada or Arizona. It's full day travel each way. It just doesn't make sense. So, I don't recommend you go, across the country if you're getting started in this business. All right, you can advance the slide, buddy. Okay, here's some great websites to check demographics. So once you pick a market that you like, you're going to want to check it out, and you're going to want to make sure 3 things are increasing. And those 3 things are population, income, and jobs. You don't want to see those declining or even flatline, frankly. And these are a couple of websites. You can write down another one. Bestplaces.net is awesome. Census.gov is awesome. Also, city-data.com is another one. And it's so easy. I know this may sound intimidating, but it's so easy to get this information. You go on these websites and you just look at your sub-market, and you can identify all these things. You want to make sure the median home price is at least $80,000. You want to make sure vacancy is not in excess of 20%. Very few places in the country that have much vacancy right now, but double check it anyway. And so you're just going to make sure those things are there, and that's how you do kind of a high level analysis of the demographics. So you can go ahead and advance the slide. Okay, now I already talked about this, but let me say this business, if you decided to do multifamily, if you're going to get into this as a business, it's not a solo sport. It's not like single family. You're not going to want to do this yourself. You absolutely need to build a team, and it's a relationship business. And again, you're looking for quality, not quantity, as it relates to those relationships. I mean, you want to know how many kids they have. Okay. You want to have that level of a relationship, because that's what's going to, frankly, your success will hinge on that, on the quality of the relationships that you build. This business is absolutely a team sport. Do not try to do it alone. Okay, next slide. All right, I put this slide in here just to remind me to tell you something, and that is, as you like anything, you've got to learn this business, and repetition is the mother of skill. You need to evaluate a lot of deals. Now, what you're going to find is if you get a package from a broker on LoopNet on a property, what you're going to find is it's 95% pro forma, meaning what that broker thinks the property will do, which frankly is toilet paper. Okay. You need to know what the property has done historically. You need to know what the actual income and expenses have been for that property, over the last 12 months. It's called the trailing 12. You want to know, or ideally over the last 3 years, how well has it done? And, what has the income been? What have the expenses been? And unfortunately, you don't get a lot of that data with a broker package. Until you have a property under contract, that's when you get the real backup and the real meat that you need to do a proper due diligence. Auctions are a fantastic place to learn, okay? Now, there are about 12 national auction companies out there. I've got a list of them in my book, and I'll tell you how you can get my book for free at the end of this thing. But just if you just Google commercial real estate auctions, you'll find them. And the reason I tell my students to register on all the commercial real estate auction sites is they're a great place to learn. And here's why. If you are the successful bidder at an auction, let's say you find a property and you bid on it and you're the successful bidder, it's your deal. If you back out, you lose a lot of money. Okay. So, and the thing of it is, you're doing the due diligence on a property at auction in advance of the auction date. So you're doing your due diligence before you bid on it, and you're doing the due diligence on a property you're not even sure you're going to get. And because of that, the due diligence is usually much less than you would do if you bought a property from a broker on LoopNet. You're going to put it under contract. You typically have 30 days to fully evaluate the property before your earnest money goes hard, meaning it's non-refundable. Okay, with an auction property, you don't have that luxury. And because of that, the packages that an auction house will send you are usually much bigger than you'll get from a broker. You'll get a whole bunch of, they'll throw the kitchen sink in there. They'll throw appraisals in there, third-party reports like surveys and building inspection reports and environmental reports and things that will help you learn this business. So it's a great place to learn. Let me give you a couple quick caveats though. Do not attempt to take an auction property down as your first property if you're new to this business. And here's why. Unscrupulous sellers will sometimes put properties up for auction that have defects, hoping that they get missed because of that due diligence fuse, that short due diligence fuse. So have someone like me or someone that's done this business looking over your shoulder. Just be careful with that. Second thing, if you've never bought at auction, realize that in all auctions, they put very low opening bid prices down by design to get you emotional, to get you excited, and to get you bidding and hopefully overbidding. So beware of that. And then the last tip is set up a separate email address when you register in these auction houses, because they will drive you crazy. Okay, next slide. Okay, so if you're going to, once you pick a market, and if you're serious about this and you're going to get into this business, there's nothing better than direct to seller marketing. But let me give you some tips on to really maximize this, because we've become very, very good at this. Now, now this really, the direct to seller marketing kind of works in what I think is the sweet spot, which is under 50 units, 50 units or under. And here's why. Because number one, it's mom and pop sellers. Okay. For the most part, you're not going to deal with a lot of institutional investors in the under 50 unit range. The other thing is you can typically find out who they are and mail to them. But what you're going to find is direct mail is the best way to contact owners, other than outbound calls. Outbound calls work very well as well. And, I think it's on the next slide. I talk about doing what other people aren't willing to do. But anytime you're willing to do what other people aren't, you will be a success. Okay. I will tell you, when I was in my 20s, I bought 500 houses in Denver, knocking on doors of people that were in foreclosure and offering to help them. Okay. That's what other people aren't willing to do. And again, I've got coaching students that, actually I'm getting ahead of myself, but, I've got one student, Matt Spangenberg, that pulled a list of owners that had owned in his town over 20 years, and found out where they lived, if they lived in his town, and he did like 5 to 20 units in his town, and found the ones that had owned 20 years and went and knocked on their home door and said, hey, do you own that property over on whatever street? And he has bought 3 properties that way, a 6-unit, an 8-unit, another 6-unit, just by going and knocking on their doors. Again, doing what other people aren't willing to do. But back to mailing for a minute. You don't have to reverse the slide, but I want to talk about it just for a little bit more. Here's some tips that if you decide you're going to do this as a business and you committed to an area, you're going to buy there, then I highly recommend you do direct to seller marketing, because you're going to get off market deals. And in this hot market, those are the best deals right now. So if you're going to do that, I recommend a few things. Number one, you pull a list of people that have owned at least 20 years. I mean, if the list is too small, you can go to 10, but ideally 20. And there's a few reasons why I'll tell you about in a minute. But the second thing is, when you pull that list, what you're going to find is most of those properties are owned in entities. Okay, they're owned in LLCs or corporations or partnerships. And if you mail to the registered agent for that entity, well, I mean, you can imagine what happens to that mail. It ends up in the trash. So what we do is we actually look up each entity, and here in Florida, it would be in sunbiz.org, but you go to the Secretary of State's office and you look up that entity and you get the names of the principals and their home addresses and you mail them there. And I know you're saying that sounds like a lot of work, and it is a lot of work. I actually hire virtual assistants in the Philippines to do this. But I'm going to tell you that with most mail, if you get a 1% response, you are knocking it out of the park. I'm going to tell you that we average a 6 to 9% response rate. 100 letters, we get 6 to 9 calls because of the things I just told you. We also do some tricks with the letters and the envelopes to enhance the open rate. But again, it's an example of doing what other people aren't willing to do. All right, you can advance it now. Okay. Let me just mention this to you briefly. If you're in the single family space, you probably know what this term means, but wholesaling means putting a property under contract and then selling it to another buyer. Okay. And the reason I want to mention it is that if you get into this business and you decide you're going to do direct to seller marketing, you really want to get a list of buyers in your market. And the reason being, I mean, I talked about this on my podcast, actually, early on in my podcast, how I had a friend that put a apartment building here in Sarasota under contract and sold it within a couple of days and made $100,000. It was actually my brother. He just didn't want me to say it was him on the podcast, but he put a property under contract and he was connected in the community here, and the guy was asking 1.7 million. He put it under contract, I think, for 1.1. And then put it on LoopNet for 1.2 and change and sold it in a few days and made $100,000. I've got a coaching student that just posted checks a couple of months ago for a $100,000 deal he wholesaled. So the point here is, if you're going to do direct to seller marketing, there are going to be deals that you either don't want to do or can't do. You're crazy not to have some other buyers in your Rolodex to contact in that eventuality. Okay, you can go to the next one. Okay, this is really important because rents have gone up so much. Let me give you a scenario. Let's say that you find a 25 unit in a town that you're not familiar with, but it's all 2-bedroom units, and you're going to want to figure out what the market rents are, right? So you can properly evaluate it. So you might go on Zillow and apartments.com and RentBits and Rentometer and see what 2 bedrooms are renting for, right? Well, I'm going to tell you that's not enough. You've got to pick up the phone. You've got to call competitors, and here's why. In fact, I had a friend of mine that called me a couple months ago, and he had a friend that lost out on $1 million opportunity. This guy could have wholesaled this property, made $1 million. If I'd have been coaching him, it wouldn't have happened. But here's what he did, and here's what I don't want you to do. So when you find a property, it's critical that you're comparing apples to apples. Let me give you an example. Let's say that 25 unit of 2-bedroom units is all the utilities are separately metered. So the tenants pay their own utilities. And you compare it to a property that the owner pays the water. That can be a $50 a month per unit difference. Okay. If the owner pays water and gas, it could be 100 or more. Or let's say your building has washer dryer hookups and you compare it to one that doesn't. That can be a $50 a month difference. To give you an idea of the ramification of this, and this is an example of, any improvement to the NOI is an exponential improvement to the value. If you have a 25 unit property and you raise the rents $50, you've just instantly increased the value $250,000. That's how big a deal this is. That's why it's so critical to get the rents right. So just pick up the phone and do your homework. Don't be lazy about it, because again, you'll have that guy. The example I mentioned was about utilities. The guy didn't check on the utilities, and the owner paid, and he lost on an incredible opportunity. Anyway, you can advance the slide. Okay, this is kind of a back of the napkin thing. It's very simplistic. I on my podcast interviewed a guy named Grant Cardone. That name may be familiar to some of you. He's got a pretty big presence online, but he's got thousands of units. He's got his own jet, and what he does, and we do it as well, I mean, it's very quick back of the napkin check, but you take a look at the historical financials. You take a look at what the property has earned over the last few years, and you look at the worst month, in that time frame that you have accurate information on. And then you calculate what your new mortgage payment is going to be when you get a loan on this property. And then you just compare the two. And if the property won't support your new debt in the worst month in the last few years, that's a clue. Okay, so I know it's very simplistic and you've got to go much deeper than this, but just a quick back of the napkin check that he uses and we even use on occasion. So the DSCR, if you'll see it on the slide, is debt service coverage ratio. And what that is, let me just give you a quick description. The bank, when they're loaning on commercial multifamily, they actually pay much more attention to the property's ability to service the debt than they do to your personal ability. The debt service coverage ratio is the property's ability to service the debt. And so let me give you an example. Let's say that your net operating income is $100,000 and your mortgage payments annualized. This is annual, by the way. You annualize all these numbers. So let's say the mortgage payment's $100,000 and the net income is $100,000. That is a debt service coverage ratio of 1. Okay. Now, let's say that your rents, your net operating income is $125,000 for the year, and your mortgage payment is only $100,000. That's a debt service coverage ratio of 1.25. Does that make sense? Or let's say you've got $150,000 in net income, your mortgage is only $100,000. That's a debt service coverage ratio of 1.5. A bank will want to see 1.25 minimum. I personally won't buy unless I can get 1.6. So, okay, you can advance. Okay, if you do that direct to seller campaign, again, if you're going to do this as a business, I want to give you a few tips here. This may not apply to all of you if you want to invest in other people's properties, but if you're going to do this yourself, and especially if you're going to mail to people that have owned 20 plus years, you're definitely going to want to understand what I'm going to tell you now, because what you're going to find is when you get calls from these people that you've contacted that have owned 20 years is they're all retired, okay? And if someone is retired, they're not going to take the money they made from from selling that asset and put it into another high-risk investment. They're going to, when people get older, their risk threshold diminishes. And so they're going to take that money and they're going to put it in a CD and, at the bank and maybe make 1% interest on it. The other thing is, if they've owned 20 years, they're fully depreciated. So that, when they sell, they're going to only end up with 65, 70 cents on the dollar. So you want to be very good at having a conversation, something like this. Mr. and Mrs. Seller, I'm going to buy your property for $1 million, but, because as you're fully depreciated, Uncle Sam's going to take their chunks. You'll end up with 650 or 700,000. Now, when you put this in the bank, here's what your payment will be. And I suggest you actually calculate it out for them so you can show them in hard numbers. Here's what your payment will be. Now, if you work with me, I'm going to give you enough of a down payment so I'm serious, but I'm going to pay you 3, 4, 5, 6% interest, and you're only going to pay taxes on the amount that you receive from me every year. So your payment from me will be 3, maybe 4 times what you're going to get from the bank, and it usually is at least 3 times, sometimes 4 times. So it really is in their best interest to offer you financing. Because typically they just want the cash flow anyway, but you want to be very congruent in having that conversation. Hopefully that makes sense. All right, you can advance the slide. Okay, I'm glad I put this in. This is one little thing, especially if you're going after people that have owned 20 plus years, they're retirees. The relationship is more important than the deal. It's very, very important that you bond with the seller. And focus on making friends before you focus on cutting a deal. And I will tell you how important this is. And this is not to take advantage of old people. I'll hunt you down if you do that. This is to create a win-win situation. And, I've done deals where I've bonded with the seller, nothing down, large deals, okay, because they just wanted the payments. I've done large deals where I haven't made a payment for a year because the property needed work. And I told him, hey, I'm going to put money into the property first, get this asset back in shape before I start paying you. And it was the truth. And I had bonded with them and we put the deal together. So don't underestimate the importance of the relationship, especially with older people. Next slide. Okay, let's talk about syndication versus partnership. Okay, the example I gave you where I bought tens of millions of dollars worth of property in my 20s, 50-50 with partners, those were partnerships because our deal was in most of the cases that if I spent more than a certain amount of money, I don't even remember what it was now, may have been 1,000, may have been 3,000. This is, 3 decades ago, but actually 4 decades ago. But those were a partnership because they had some decision making capability. Okay, if you get into an arrangement with someone, and they make any decisions, it can be a partnership, and you do not have to syndicate. But if you decide to do this as a business and you're going to collect money from people and just give them a return and they play no role in the deal at all, you have to syndicate. And it's no big deal. It's nothing to be intimidated by. You just have to hire an SEC attorney and do the paperwork right. It's truly not a big deal. But and there's some incredible benefits now because of the Dodd-Frank Act, where back in the day, if you did a syndication, you couldn't advertise. But now if you do what's called a 506c syndication, you can actually, which is just to accredited investors, you can advertise. And so, like right now, I'm doing this deal in Dallas, and if you're accredited, give us a call. You just text the word partner to 41411 and we'll tell you about it. Partner to 41411. And I can do that because if you're accredited, I can actually, solicit you. But if you there is what's called a 506b syndication, which was the old one, the one I learned on, decades ago. And with that, you have to have a relationship. You have to have an existing relationship. And it used to be called the 3-touch rule. You have to talk to somebody 3 times before you can present a deal to them. Okay. So that's very high level, understanding of syndication. But the bottom line is, if you're going to do this business, you're going to want to connect with an SEC attorney and build a relationship and spend an hour on the phone with them so you've got an understanding of this, and have them help you through the deal, or better yet, align with somebody that's done it and have them walk you through it. All right, you can go to the next slide. Okay, let's talk about due diligence. I'm just going to give you something real high level. What's really important here is that you've got a comprehensive checklist. I mean, we've got the best checklist in the business in my materials, but in my books, got a fairly decent one as well. But you're going to really want to make sure that you've got a checklist. So you check off every box, you look under every rock, you make every phone call that needs to be made. Because I will tell you, what's amazing about this business is it's primarily empirical. It's primarily numbers. And if you understand how to evaluate a deal and do the numbers, all other things being equal, of course, you're going to have the property inspected and all that, and you're going to make sure you're not in a declining area. But it's pretty basic, common sense stuff. But you still want a checklist, so you don't, you do everything you need to do, and you check off all those boxes. It's very unlikely you'll make a mistake. But what I want to tell you at a high level that's very important is it's human nature. Let's say you found that 25 unit that we were just using as an example, and you get it under contract, and you looked at 100 properties to find this deal, and you're all excited, and you're doing backflips the whole way home to your spouse, and you finally got a deal under contract. Well, I'm going to tell you, at that very moment, you need to stop, take a deep breath, and put on the hat that says, why do I not want to do this deal? And it's not an easy thing to do, and here's why. Because it's human nature, once we make a decision, to look for reasons to substantiate or bolster or shore up that original decision we made. And you can't do that in this business. You've got to put on the hat that says, why do I not want to do this deal? And it's a mindset shift. I know that sounds basic, but I will tell you that if you don't do that, you could subconsciously overlook one of the things on your checklist or overlook something you shouldn't overlook. And that's when the mistakes get made. So very, very important. All right, you can advance it. Okay, I think this is the last thing I'm talking about, and just again at a high level, I recommend that if you're going to do this business and do it as a business, that you focus on finding deals. You don't deal with toilets, at least not initially. You don't manage your own properties, in other words. Now, if you listen to my podcast, you'll think that I'm an advocate for self-management, which I am, once you stop buying or once you've got enough of an infrastructure where you can hire a person to manage the managers versus a property management company. But initially, you should hire a third-party property management company. And again, you're going to want a big list of, questions to ask them about how they do it and what they do. They're going to want to have an office in the area that your property's in. You're going to want to make sure that they manage property, like yours. You don't want a property management company that manages 100-unit properties managing your 20-unit, because they aren't going to know how to do it. Or vice versa. You don't want a company that specializes in 20, 30, 40 units managing your 120 unit. They're completely different animals. But let me just tell you at a high level thing, a couple of very important pieces. Number one is, pay attention to how they handle maintenance, especially if you're in the smaller properties under 60 units. If it's over 60, you're going to have your own on-site maintenance person, and this won't apply as much. But if it's under 60, it's very likely you're going to rely on their maintenance infrastructure. And maintenance can be a real profit center for a management company. For example, they'll hire some kid at $15 an hour and bill them out at 100. So you really want to dig into what they charge. Do they use their own employees? Do they use subcontractors? Do they upcharge the subcontractors, just to make sure you don't get screwed, so very important. Second thing is, in this business, you want to make sure that the management company has a great online presence, because if somebody pulls up in front of your 25 unit and they're like my wife, who lives on her phone, it's really half the world, half the population now lives on their phone. They better be able to, if they pull up in front of your 25 unit, they better be able to see pictures of the units, do a virtual tour, definitely apply for a unit online, because if not, you've just lost them. Okay. Certainly all millennials, and just about, it's really becoming, that number is getting bigger than 50% all the time. And the point is, there are still, oh, you know what? I forgot to say something, but I'll come back to it. There's still some digital dinosaurs out there, okay, and that haven't embraced technology. And let me just say this, and what I forgot to tell you is, you're going to find the best people in this business by asking for referrals. You're going to ask the brokers, who are the great property management companies. You're going to ask the property management companies, who are great brokers, great lenders, great real estate attorneys. And that's how you're going to find the best people. You don't go find them on Google. You're going to find them through referrals. So trust me, that's how you want to do it. But, you may hear the same property management company come up more than once. But if they are still a digital dinosaur, hate to say it, don't use them, because, they're going to lose. They're not going to rent your property as quickly. So, all right, brother, that's all I got, Alex. So if you want to open it up to a few questions, I think we've got a few minutes left.
Yeah, absolutely. I just want to again thank you very much for being a part of this today. We have some Q&A rolling in. Please, everyone, type in the questions that you have. We'll get through them here. We got a few more minutes to respect your time and make sure we get you out of here as well. Is that if you are interested in getting some more with Rod, he's doing a class here in the Tampa Bay area, January 18th to the 20th. Looking forward to seeing everyone there. If you were registered for this, there is a discount code that I will email out for this. So if you were an Advanta registrant, we do appreciate him extending that to you as well. And
yeah, let me speak to that for just a second, if I may. Go back to that last slide for 1 second. So guys, I do 4 of these events a year. They always sell out, and it's just me on stage teaching you about this business. I mean, you can go for as low as $297 with the discount code I gave Alex to give you guys. But I don't bring in outside speakers to sell you stuff. So if you're serious about this business, I promise you'll be glad you came. Also want to mention that if you're interested in this multifamily space, I've got a Facebook group, and we're about to hit 23,000 members. And if you just go to multifamilycommunity.com, it's a direct link to that Facebook group. And if you're going to do this, you want to be around other people that are doing it. It's like the adage, you are the 5 people you hang around with. Your peers are very, very important. So be sure that you connect with people that are doing this business. Maybe you go to your local real estate investor club meetings if they focus on multifamily, but that Facebook group's a great place to connect and learn. We don't allow any promotion there. It's just an educational platform, so it's awesome.
Yeah, it's going to be a good time. I'm looking forward to attending as well. But just to make sure we get through the Q&A, again, we'll send out the link and the discount code and how to get in touch with you as well, and also the information right up here on the slide to
one last thing, Alex. I forgot to mention the book. I've got a free book. It's going on Amazon here probably in 2 weeks. It'll be $24.95. If you want it for free, just text the word Rod to 41411. You get a free copy. It's no fluff. It's 200 pages like a textbook. Rod to 41411, and we'll get you a free copy before it goes on Amazon.
Yeah, great deal on that. So we have Manuel asked, when doing seller financing, what is the best strategy to go about getting private money partners to help you with the down payment and or rehab costs?
Well, listen, Manuel, if you find the deals, you're going to find the money. Okay. You just need to be out there. If someone stands still long enough, they need to know what it is you do. And you need to develop what's called an elevator pitch. So, you might say something like, I've been finding apartment deals with great returns, and I'm always looking for partners. So if you know somebody that, might be interested, please let me know. And you just, again, if they stand still long enough, they better know what it is you're doing. That's the best way. It's just word of mouth. You have to develop those relationships. You make friendships, like I said, quality, not quantity. And that's how you'll find the money. And then when you find that, if you do these things simultaneously, you're out there looking for deals while you're out there looking for people with money. That there's so many people out there that are getting poor returns, that are scared of the stock market, people that have money in their IRA, of course. There are a lot of people out there that have big IRA balances, and real estate's a fantastic investment for them, which is, why I wanted to be on this show with Alex and Advanta. But you've got to be out there talking about it. That's the best way.
Absolutely. We have a question about accredited investor criteria. What is your criteria? It's actually the government's criteria for accredited investors. Is 1 million in assets enough, or having 2 properties enough? Just briefly, there's a bunch of different ways to qualify for that, Amir. A good way to do it is to just look up the Jobs Act qualification for accredited investors, and we'll list out dollar for dollar net assets versus trust
I can
assets.
tell you, it's 200,000 in income if you're single, 300,000 if you're married. It's $1 million in assets, not including your personal residence. That makes you accredited. And there's there's a qualification process you have to go through. You get a CPA letter, or we have a portal where you self-affirm, accredit yourself. Right.
Yeah, and again, Amir, there's that in writing. It's an easy Google search. It's all over the place for that information. It wouldn't necessarily just be having 2 properties, although that certainly could factor into that, depending on if those are personal assets or personal homes and things like that. So again, what he said is absolutely right. Just do a little research, and it's not hard to figure that one out. Let's see. Ranjit, unfortunately, with regard to our compliance, we can't necessarily get into the actual returns for that kind of stuff. But of course, if you want to reach out to Rod outside of this, I'm sure he would be more than happy to get into the actual return rates on some of these things that have been seen and different markets, things like that. But your other question, we certainly can't touch on. Talking about DSCR, when you said 1.6 ratio, are you taking into account the down payment or not? For example, if you buy a property for 1 million and let's say you have 100K in mortgage, did you put any down payment?
Well, yeah, if you buy a property for $1 million, you put 900,000 down, then you're gonna have a pretty good debt service coverage ratio. No, of course we are, and we the lending institutions are going to dictate the minimum down. I mean, it's becoming higher and higher. Used to be able to get 80% financing. That's harder now, and it's down as low as 70. I think we're doing 68 on that deal, 68% loan to value on that deal in Dallas. But and you want to look at all factors involved in the deal. You want to stress test. It's very, very critical that you stress test a deal. If you're going to buy a deal, you look at, what happens if we're 15% vacant? What happens if the rents drop? And make sure that you can still pay the bills. And so, it's very, very important. There are a lot of syndicators out there that didn't go through the crash that I went through. I lost $50 million in 2008. It was, I call them seminars. It was my biggest seminar ever. And because of that, I'm very, very conservative. But there are syndicators out there, operators that are not stress testing deals. And that's a recipe for disaster, because we are going to have a contraction. There's no question. Now, is this something to be afraid of? No. There will be incredible opportunities. But, if you're not stress testing your deal, or let's say you get short-term debt, most of the time you're going to have a balloon payment with commercial financing, anywhere from 5 to 10 years. You do not want to do 5-year debt right now, because if your balloon comes payable and you haven't And let me tell you what the definition of a bad day. A bad day is owning an asset, an apartment complex that's cash flowing well, but because the cap rates have gone up, your value has gone down, you can't refinance and you're in a short-term debt and you're going to lose the property that's cash flowing because you can't get the value that you need, or you have to put a bunch of money in to try to refinance it. That's a bad day. And so very, very important. I tell my coaching students, ideally go for 10-year debt, minimum 7. Hopefully that answered his question.
Yeah, absolutely. I think it was definitely very, very complete on that one. Good one from Medwell asks, how come there are deals out there tailored specifically to accredited investors and also non-accredited people as well? So maybe a little bit of the difference about the deals targeted to each group.
Well, there are three, the three most popular syndication types deals are a 506B, which is non-accredited investors, sophisticated investors, and you need to have a relationship with them, or a 506C, which is accredited investors. But the belle of the ball now is called Reg A. And you have to get SEC approval. It costs a little more money. It takes a little longer. You have to do an audit. You have to present a CPA audit, but then you can actually advertise to accredited and non-accredited. So it's becoming the belle of the ball. So I didn't want to get too deep into syndication, but good question. So there's your answer, brother.
Great. Okay, we got a really good one, I think, that everyone would certainly be good with. Can you briefly explain the B, C, and D property ranges a little bit more? I'll give a little bit additional insight into that.
Sure. It really is how old the properties are. You know, a B property can be, let's say, 10 to 30 years old. C property, maybe 20 to 40 years old. There's a lot of subjectivity to this. Okay, just so you know, this is not a hard, fast rule. And then D is typically 50 to 100 years old. D properties are have no amenities. An A property will have the most amenities. B property will have some amenities. C property, maybe you can bring amenities in and turn it into a B property. C properties may have a little bit of functional obsolescence, where maybe the bedrooms are smaller, the ceilings are lower, things of that nature that are very, very difficult to correct. B properties, you won't get functional obsolescence typically, but it relates to the age and the condition, again, there's some subjectivity to it. I would Google it. You might get some firmer definitions. For me, it's like second nature. I can look at a property and tell, but I understand why you asked the question. And again, we look for B and C properties that we can raise up one level. Like we just did a deal in Ohio. It was a B property, and we're renovating it now, and it will be an A property when we're done because it's in an A area, and we're adding amenities that'll really make it to qualify as an A property. So that's what we look for, something we can add value to and enhance it to enhance that rating.
Sure, and
it's still subjective though. I mean, it doesn't mean like it's noted anywhere publicly or anything like that. It's just it's just a way to define it.
And would you say that definition doesn't have as much bearing on location? For example, for those of you that are in the local area, an area of St. Pete has a lot of apartment stuff in the downtown area close to the water. So would you say that something like that would maybe qualify, like raise if you were to take that 50-year-old building in another area from a C to a B, or would it still kind of be considered?
The area matters, but see, there's area classifications as well as the property itself. The classifications on the property really relate to the property more than the area. Then the area, you can have a brand new property that goes up in an area that's questionable. Well, you wouldn't really because they do their homework, but as an example, you might have a C property in a D area, okay, and not much you can do there unless it's gentrifying. So the two aren't necessarily synonymous. They go together, but you have both dynamics. You have the area dynamic, and then you have the actual condition of the physical property as well.
Gotcha. So it's definitely not the same type of correlation that we see in single family. It's definitely its own thing that people need to research on for the multifamily space.
No question.
Great. Okay, we're getting right up on there. Let me just go through the last couple questions. Let's see. What about competition for apartments from co-living companies and trends with millennials? Not exactly
Well,
sure what
sure.
that
There's a
question is, but
lot of that.
maybe.
Yeah, there's a lot of that going on, and there's some real opportunities to Airbnb units. So that there's some opportunity there. Now, unfortunately, Alex, I've got a hard stop because I've got an interview here in just 2 minutes.
Hey, not a
So
problem.
maybe we
We're
can
right
do
up on
one
our
more
time
real
limit as
quick.
well.
Yeah.
And then, yeah, the last one. Do you know of any good websites to find owners of older properties in particular?
Well, I would go to your county assessor's website and pull lists. Okay, I mean it's work, but you can hire a VA in the Philippines to do that. We teach people in my course how to do it, but you can just go on and hire somebody to do this homework for you. But go to the assessor's office, pull your list, then dig in and look up those entities and get their home addresses and mail them there. You handwrite the envelope, type the letter. Um,
Absolutely. That's great advice for any type of investing you're doing. I've heard
right.
that from the multifamily to the single family. Again, I know you got to get out of here, Rod. Thank you
Yep.
very much for being a part of this today.
Oh,
We
my
really do
pleasure.
appreciate it.
Hopefully added some value to you guys. And Happy New Year, my friends.
Absolutely. Have a great day.
All right, thanks. See you.